Well, good afternoon, everybody, and welcome to this webinar, State Pension Explained, where I'm going to be aiming to demystify the state pension in just 30 minutes. Now, for those of you who don't know me, I'm Sarah Steele, the owner of Better With Money, and we're a company that provide financial education in the workplace to help people understand their finances and to reduce money stress. And today we're providing this free webinar to support Talk Money Week. And that's a national initiative aiming to reduce the stigma around money, really trying to encourage communities and friends and families to open up and talk about money. Because research has shown that if we can overcome our inability to talk about money, if we can actually sit down and discuss budgets with our partners and our families, it can have a really positive impact on how we feel about money. And it also reduces the likelihood that we're going to have money rows, which is really important for our overall health and our relationships. Because if we're managing our finances well, it gives us more time to manage the rest of our lives too. And this webinar is just one in a series of financial education sessions that we provide through the workplace to improve financial well-being. So if you want more information on the services that we can offer, please do visit our website at betterwithmoney.com. Now, just a few notes before I start. Thank you to everybody for sending through all of the lovely questions that you have done already. I'm going to be picking those up throughout the webinar. We'll also do a Q&A session at the end. If you've still got a burning question that you'd like to ask, please put this into the questions box that you'll find on your pop-up. The important thing is that all of the questions, they're totally anonymous to the other attendees. It's only going to be me that can see them, so please don't be afraid to ask. But as I say, we have had loads in already. So if we do overrun by 1 p.m. ever so slightly, please don't worry if you need to go. We are recording this session and we will send it out to you by email about this time tomorrow lunchtime. Lastly, before I get started, we're only providing information today. We're not giving you financial advice. The aim is that we just give you the knowledge and the tools to improve your money situation. And lastly, and this is really important, Better With Money is not connected to any other organisation. We don't get any financial incentives from any company to mention them. So if I am mentioning companies or services along the way when I answer your questions, it's because we genuinely believe that they offer good services that you can take advantage of, not because we're connected to them. Okay, if I keep glancing up here, that's because I can see some of the questions coming through. Right, so what am I going to do for the next half an hour? I'm going to start off by explaining the state pension, just by using a series of questions to set the scene. So we're going to go through things like, what is it? When do I receive the state pension? How much am I likely to get? Is it going to be enough? And then once I've done that, I've got about 9 slides on that. I'll take you through the questions. And as I say, we'll aim to finish by 1 o'clock. We might overrun just slightly, depending on how many more questions we have coming through. If I have too many, I'll do a Q&A sheet and I'll send it out by email after this week's out, after Talk Money Week. Okay, so let's start then. So what is the state pension? Well, the state pension is a regular payment that you can claim from the government when you reach state pension age, and it's there to provide you with a retirement income. Now, the state pension is certainly not intended to provide you with a comfortable standing of living by itself, but it is intended to give you a foundation of income that you can build upon by saving into your own pension scheme or into your workplace pension scheme. And the aim is that when you stop working, or if you decide to reduce working hours later in life when you're older, you'll have enough money to live on. Now, over the years, the rules of the state pension have changed, and the last big overhaul of the state pension happened in 2016. And that is when the government and Sir Steve Webb introduced the new state pension. And the aim of introducing this new one was really to make it simpler to understand and fairer for all. But noting by the 250 plus people on this webinar today, I think there is some work to do to really explain what the new state pension is about. Now, if we've got anybody on here who reaches the state pension on or after the 6th of April 2016, that is the new state pension that we are going to be talking about today. That's the one that I'm referring to. If you actually reach state pension age before the 6th of April 2016, you'll be entitled to the old style state pension, the basic state pension. We're not going to be covering that in detail, but I have put a link to the government website here, and I'm sure a little bit about the old state pension is going to come out through the questions and answers as well. So that brings us on neatly to the next question then. What is my state pension age? Now, I've tried to simplify this as much as possible. So here we go. If you were born after the 6th of April, 1978, your state pension age is currently 68. If you were born between the 6th of April, 1961 and the 5th of April, 1978, your state pension age is currently 67. However, there are plans afoot by the government to increase the state pension age for those people born between the 6th of April 1970 and the 5th of April 1978. So that includes me. And our state pension age is going to be somewhere between age 67 and 68. So it could be 67 and 1 month, 67 and 6 months. It's going to depend on when your birthday is, but those changes are still going through Parliament, so we need to watch this space on that one. If you were born before 1961, your state pension age is going to be somewhere between 65 and 67. But of course, there are always exceptions to the rules. So if you're a woman born before 1960, your state pension age is going to be somewhere between 60 and 65. But rather than me putting up a very long-winded table showing all the possibilities about state pension age, the easiest way to check yours is actually to use the state pension age checker tool, which is on the gov.uk website, and I've shown that on the slide here. You can also use the same link to check when you're going to be eligible for your free bus pass in your area. Isn't that good to know? For England, you have to reach state pension age to get your free bus pass, unless you live in London, in which case you can get it from 60. Just a little bit of extra information there. Now, just to note here, before we move on from state pension age, it could change again in future. And the reason for that is that people are living longer, we're spending more time in retirement, and so the state pensions are costing the government more than they did when they first got introduced back in the 1940s. However, in order to change state pension ages, the government does need to agree and pass a new law first. So just watch this space. As I said, particularly if you're born between 1970 and 1978, your state pension age is likely to go up a little bit. So how much are you likely to get? That's the next thing. Well, the state pension is a contribution based. And what that means is it's relying on us now, us people that are working, to pay national insurance contributions to fund the people who are now eligible for their state pensions. And to be eligible for the full new state pension, which for this tax year is £179.60 a week, or that's just over £9,339 a year, you are going to need 35 qualifying years under the new state pension rules. So how do you build up a qualifying year? Well, you can do it in a few ways. So the first way you can build up a qualifying year is to earn at least the lower earnings limit across the year. And for this tax year, that's £6,240, or if you change that to weekly, that's £120 a week. Now, you could earn more in some weeks, less in others, but as long as you've reached that minimum threshold of 6,240 for the year, then you will have earned a qualifying year towards the state pension. Now, some of you who might understand national insurance out there will know that you don't actually start paying national insurance until your weekly earnings get to £184 a week, but that doesn't matter. As long as you hit that £120 lower level, even if you're not paying national insurance, you will still get that qualifying year. If you're self-employed, you can earn a qualifying year if you've got profits of above £6,515 in this year and you're paying national insurance contributions. However, you might be somebody that doesn't earn that much. You might have partners, spouses, family that don't. But don't worry, you can also build up national insurance credits to give you that qualifying year by claiming certain state benefits. And they include child benefit for a child who's under 12, or you might receive a state benefit like universal credit for people on low incomes, job seekers allowance, so that's what you receive if you're looking for a new job. Employment support allowance, that's if you've got a disability or a health condition that limits how much you can work, or the working tax credit, again, if you're on that low income. If you receive any of these benefits, you'll automatically be credited with a qualifying year towards the state pension. There are also another few things that I wanted to mention that you can get credits for. So other things would include if you're caring for somebody for more than 20 hours a week, even if you're not getting a carer's allowance. It could be if you're on jury service, it could be if you're the partner of somebody in the armed forces, or maybe you've attended a government training course, or you've been wrongly imprisoned. For all of those reasons, you can get a credit, as can grandparents. So if you are grandparents that are under state pension age and you are providing care for a child under 12, probably your grandchildren, again, you might be able to get national insurance credits. But for all of those last things that I mentioned, you don't get credits automatically. You do need to apply for them in writing at HMRC, and you can find that address on the gov.uk website. So just to recap then, in order to build up your right for the new state pension, you need qualifying years, and you need 35 qualifying years in order to get that full amount, which is that 9,339 per annum. Now, you do need to have had at least 10 qualifying years to receive any state pension at all. But those 10 don't need to be 10 in a row. So if you've worked some years, had some years off, gone travelling, worked a bit more, as long as you've got your 10 qualifying years overall, then you will get some state pension. And if you've got 10 years, you'll get 10 35ths of what the full state pension is. So for this year, if you had 10 qualifying years, you'd get 2,668 a year. Now, again, the easiest way for you to find out how much you're on track to receive from your state pension is to apply for your state pension forecast online. And you can do that at the gov.uk website, again, which I've shown on the slide, or if you're in Northern Ireland, it's NI Direct website. And this is going to tell you, one, what your state pension age is, so that's a big tick, how much you're likely to get based on your national insurance contribution record to date, and you'll also be able to see your national insurance history contribution history. But to get that online, you are required to have an HMRC login. Now, if you don't have a tax login, you don't do self-assessment or anything like that, and you don't want to create one, if you want to, you can fill in the form BR19. And again, you'll find that on the gov.uk website. You can just print it off, post it back to them at the Newcastle Pension Centre. But it can take up to 6 weeks if you do it by post. And the other option, if you don't want to do it by post, you don't want to do it online, is that you can phone the Future Pension Centre helpline, and that's shown on the slide here. So once you know how much you're going to get and when your pension age is and how you build up those qualifying years, what's actually going to happen when you get to state pension age? Well, there's a really important thing I wanted to mention here, and that is that you don't get it automatically. You actually have to claim it. Now, what should happen, of course, is that you receive a letter at least 8 weeks before your state pension age, and it will tell you how to claim your state pension. But roughly, you can do it online at the gov.uk website, or you can phone the state pension claim line I've shown here, or you can fill in a claim form that you print off from the website and you send it to the pension service, again at the address shown. Once you've done one of those things, then the state pension should start within 5 weeks of your state pension age, and it's going to be paid to you about every 4 weeks in arrears after that. And this is the really exciting bit. Now, if any of you joined the session we did during Pension Awareness Live, this was the bit of information that got the most feedback. Okay, so the day of the week that you're going to be paid your state pension is going to depend on your national insurance number. So we all know our national insurance number, we have 2 letters at the beginning, then we have 6 numbers, and then we have a letter at the end. If you take the last 2 numbers, if they're between 0 and 19, you're going to be paid your state pension on a Monday. If it's between 20 and 39, it's going to be on a Tuesday. If it's between 40 and 59, it's going to be a Wednesday, and so on. I mean, probably a totally useless bit of information right now, but I found it quite interesting, so I thought I'd share that. Okay, now once the state pension is in payment, it's going to increase every year. And at the moment, the state pension increases by the larger of either the previous September's inflation rate or the earnings growth for that year, or 2.5%, whichever is the larger out of those three things. And that is what's well known and well reported on as the triple lock. But what's happened this year? The government have actually confirmed that for next year only, they will only be using a double lock, and they're going to totally disregard earnings growth. And that is because it was disproportionately high because of the pandemic. The earnings growth was around 8%. So as of April next year, anybody that's actually receiving state pension will have it increased by 3.1%. And that is the inflation figure for September. So there's going to be an increase of just under £290 for next year. The question I often get asked, and I can see it coming through, will the triple lock continue? Will that guarantee stay in place? I honestly don't know. That's anyone's guess. There are rumours it could be abolished in favour of inflation only. And if we look at this year, maybe that's one step towards abolishing the triple lock. Who knows? We could debate that for a long, long time. Okay, so the last piece of information I'm going to go through just before we open up to questions is my state pension going to be enough to live on? Well, if you only had the state pension and no other saved pensions from working, then it's very unlikely that that is going to be enough to provide you with a minimum standard of living. And actually, if you had reached state pension age this year and you had a weekly income as a single person below £177 a week, then it's likely you would be entitled to pension credits. And that is a state pension that tops up your weekly income to that minimum amount, because that is seen as the minimum that we need to be able to live. So what will you need as an income? Well, there is a rough rule of thumb that you should be aiming for about 2/3 of your pre-retirement income, particularly if you want to continue the standard of living that you've had when you're working and follow that through into retirement. But to give you an idea of the sort of income you might want to target, the retirement living standards were published a few years ago, really to give people an idea of the income that they might need to provide a minimum, moderate or comfortable retirement. And these figures were actually just very recently updated in October just gone. And the figures that you'll see up on screen here are after tax has been paid. So as you can see, the research suggests that you would need an income of £10,900 a year as a single person, or £16,700 a year as a couple, to have a minimum standard of living. So that's no car, that's £38 a week on food shopping, and sort of a 1 week and 1 weekend holiday in the UK every year. If you wanted to up that standard of living to moderate, that would increase to just over £20,000 a year for a single person, or just over £30,000 for a couple. In that instance, that kind of assumes that you'd have a 3-year-old car that you replace every 10 years, 2 weeks holiday in Europe, and you're spending more on your shopping. Or for a comfortable retirement, £33,600 for a single person and just under £50,000 for a couple. So you're replacing your car more often, you're having longer on holiday, and you're spending more on your shopping. Now, I thought it'd be interesting just to look at what the average pensioner in the UK gets, and looking at recent government data, that's about £304 a week after tax and housing costs. So that's just over £15,000 a year that the average UK pensioner gets. So that puts most people in that kind of minimum to moderate retirement income. Now, you might be sitting there thinking, I'm aiming for a lot higher than that, particularly if you're earning more than that now. So just think about, what costs are going to disappear when you retire. It might be your mortgage costs. You might not be traveling quite so much, just to give you an idea of what you should be aiming for. But the important thing is that we need to remember that the state pension can be a really good foundation for that income, particularly if you're entitled to the full amount, that £9,339 this year, which is going to keep increasing. So what you can do, and particularly if you're building up pensions through work as well, there is a pension calculator that's free to use on the Better With Money website. It's under the employee resources section. You can put in how much you've saved so far. It can pull in the state pension information, and it will just give you an idea of how much you're on track to save and what that might give you as an income in retirement. Okay, so there's the basics. We've had lots and lots of lovely questions through. I'm going to start off by going through some of the ones that I had beforehand, so I'll start on them now. So the first one said, I lived abroad for a few years. I've got a gap in my national insurance record and therefore I've missed out on qualifying years. Can I make up for that? The good news is yes, you can normally pay voluntary national insurance contributions that are going to fill any gaps in qualifying years from your previous 6 years. So you can normally only go back for the 6 years that you've missed. Now, if your gaps are because you've been abroad, you will need to have lived in the UK before you went away, and you will need to have paid national insurance contribution for 3 years in a row, I believe. But the easiest way to check if you're eligible to make voluntary contributions is to check your state pension forecast. It will tell you what is your record, and it will tell you whether you're able to make those voluntary contributions and how much they'll cost you. Now, you can also make up gaps in your national insurance record if you haven't worked, for example. You don't have to have just been abroad, but if you know that you've missed out on the last 6 years, maybe you haven't worked and you haven't claimed state benefits, or you've been self-employed and your earnings have been too low, then you can pay those voluntary contributions. Now, the voluntary contributions are calculated, how much they cost are calculated each tax year. But if you wanted to buy back this year, for example, buy one qualifying year towards your state pension, it's going to cost you £15.40 a week this year, which is going to be about £880 for the year. So you might be sitting there thinking, well, is it worth it? And I get asked that a lot. Well, let's just think about that for a moment. So the full state pension is 9339, and you need 35 qualifying years. So if you divide 9339 by 35, one qualifying year is going to give you an extra £266 worth of pension. It's costing you £880 to buy that £266 a year. So actually, as long as you receive the state pension for 4 years after your state pension age, it's going to have been worth it. You're going to be quids in by buying back that year. So I just thought I would make that clear. But you might particularly want to pay for missed years if you haven't got to that magic 10 number, because remember, you need 10 qualifying years to receive anything at all. So if you're getting to state pension age and you've only got 8, it might be worth paying 2 years worth if you can to get to the 10, so that you get at least some state pension. Right, the next question was, I'm not working, and this is great, I'm so pleased someone's picked this one out. I'm not working and I've opted out of receiving child benefit because my husband earns too much. Will I still get the credit for the state pension? So let me just give a bit of background on this one. If you've got children under the age of 16 and you and your partner have an individual income of over £50,000, when you receive that child benefit, you start paying a high income child benefit charge. So effectively, you start paying a tax on the child benefit you receive if somebody in the family and somebody in the household earns over £50,000. Now, by the time one of you has an income of over £60,000, that tax you have to pay completely wipes out the child benefit that you get in the first place. So it's best to opt out of receiving it. So let's just say that you've got a partner then, they earn more than £60,000, you're not working, you should still register for child benefit. But once you've registered, you opt out of receiving the payment. But unless you actually register for it, you are not going to get your state benefit credit, that national insurance credit, to go towards your state pension. So please register for it, but opt out if somebody in the household earns too much. If you're in doubt, if you want to chat it through, the child benefit helpline is 0300 200 3100. As I say, don't worry if you haven't got a pen and paper, you're going to get this recording tomorrow lunchtime into your email, just for you to watch, so you can go back after it. Next question was, I've got 25 qualifying years, I'm about to retire, what am I likely to get? You do 25 35ths of the full state pension, that's 6,670. Right, next question. Can I still claim state pension that I've built up if I decide to retire abroad? Yes, you can still claim the state pension even if you've moved abroad, as long as you've got that magic 10 qualifying years. But there probably will be a separate form that you need to fill out if you're retiring abroad, and you'll find that on the gov.uk website. Now, you can have that money paid into either a UK bank account or an overseas bank account, but of course you're going to have that exchange rate risk. But one thing I did want to mention, if you retire abroad, you're having the UK state pension paid, it will only increase each year if you are in an EU, a European Economic Area country, or Switzerland. If you live anywhere else, if you lived in Australia, for example, it's going to be frozen at the rate that it started being paid to you. If you then come back to the UK, it will start being increased at the point that you come back to the UK. Someone then asked, they moved to the UK 4 years ago for work. They've accumulated some money in the state pension. If they go back, will they get it? Only if you've got 10 years. So keep thinking about that magic 10 years. Right, next one, really important. Do I pay tax on my state pension? Right, no simple answer, but that is going to depend on how much income in total you've got in retirement. Now, everybody in the UK gets a personal allowance for tax, and that is the amount that we can earn without paying any tax. And this year, the standard personal allowance is 12,570. So if you only receive your state pension, which is under that 10,000 mark, that's less than your personal allowance of 12,570, so you're not going to pay any tax. However, if you get the state pension, plus you get other income from other pensions, or you carry on working, you will start paying tax at basic rate on anything you earn above that 12,570 mark, all the way up to 50,000-ish, and then you start paying higher rate tax. Your standard personal allowance could be different. You need to check that on your HMRC online, but that's the general rule. If you only get state pension, it won't be taxed because it's below your personal allowance. If you've got other income, then it would. Also, what I want to mention is, importantly, you no longer pay national insurance contributions when you reach state pension age. However, you may have heard of the new health and social care levy of 1.25% that's going to be added to our national insurance bill from April 2022. And although that's not going to be applied to any pension income you receive, you will pay that on salary, even if you're above state pension age and you carry on working. Okay, next question. What happens if I carry on working past state pension age? Well, if you want to carry on working, that's absolutely fine. You can still claim your state pension as long as you've got to that age. You don't have to stop working to claim it. Someone else said, I've had a question about whether you need to fill in a self-assessment tax return if you work past state pension age and you receive state pension at the same time. So if you're employed after state pension age and you're getting your state pension, your employer is going to deal with any tax you owe through PAYE. You don't need to do that pension return. However, if you're self-employed and you receive the state pension, you do need to complete a self-assessment tax return. And for this tax year, which ends on the 5th of April 2022, you'll need to complete that by the 31st of January 2021. Someone else has said, can I defer my state pension if I don't need it yet because I'm still working? Yes, if you want to, if you don't need the state pension income, you can defer it. But the minimum amount that you can defer it by is 9 weeks. And the state pension will increase by about 1% for every 9 weeks that you defer it. So that's an increase of about 5.8% for the year. Should you do it? There are pros and cons. It could be appealing to defer it, particularly if you're still living abroad and you're in a country like Australia where the state pension wouldn't increase. However, you're giving up, nearly £9,000 a year in return for a £550 a year increase. So you're going to need to receive that state pension for more than 17 years before you make up any loss income for deferring it. So do think very carefully about that. Next question, brilliant one. If I've got more than 35 years of national insurance contributions, will my pension be increased? No, it won't. Once you've got to 35 years, that's it. Will I be eligible for state pension if I move into a care home? Yes, if you move into a care home, regardless of whether you're paying or whether the NHS are paying for that, you'll still be eligible. Now, we have got to near enough 1 o'clock, but I'm getting on to a really important question. So if you can stay for 5 minutes, please do that. Because someone has said, I've heard that I'm going to get a lower state pension because I was a member of a final salary pension scheme when I was working. Is this true? Okay, this is one we need to concentrate on, and I'm going to try and make it as simple as possible because this is where contracting out comes in. So under the old state pension, if you retired before 2016, the old state pension was made up of 2 parts. There was the basic state pension, which everyone became entitled to by paying national insurance. But then there was also something called the additional state pension, and you earned the right to that by paying more national insurance. So the more you earn, the higher the national insurance you paid, the higher the additional state pension piece was going to be. It was earnings related. However, many final salary or defined benefit pension schemes decided to contract out. And what that meant was that if you were a member of one of those schemes, you actually paid a lower national insurance contribution, and in return, that pension scheme had to guarantee you a minimum level of pension instead of you getting an additional state pension from the government. So if you were contracted out, you got the basic state pension, and then you got the rest of your pension through your workplace pension. You didn't get the additional state pension that you were entitled to. So someone that wasn't contracted out, sorry, let me start again. So you've got the basic state pension and you've got your company pension if you were contracted out. The other thing that you could do is if you had a personal pension, is that you could contract out through that. And in that instance, you did pay your normal national insurance rate, but some of it was rebated and put back into your personal pension to invest. And people did that because they thought, I'm going to get a higher return on my money than if I just leave it with the government. Okay, so that's what contracting out was. And then what happened is that the new state pension came in 2016. Contracting out was abolished. So the government had to find a way of making sure that nobody was going to be worse off based on the state pension they'd already built up to 2016. So what they decided to do was calculate at that stage, anybody that was working and paying national insurance, they calculated our starting amount. And our starting amount was either the higher of anything that we had built up the right to under the old state pension rules, or ignoring that, what we would have built up if the new state pension rules had been in place. So if you were contracted out under a defined benefit pension scheme, that starting amount would have had a deduction because you were contracted out. So potentially, if you're about to retire right now, you might have missed out slightly. However, if you've been contracted out in the past and you've still got at least 5 years to retirement, the likelihood is that under new state pension rules, you're not going to be worse off. Now, I'm sorry, that was quite a long explanation. I'll put that in the Q&A handout that I do. Right, next really important question. Will my state pension pass to my wife if I die? If you reach state pension after 2016, the new state pension is only going to be based on your own national insurance record. It's not going to be based on anybody else's, and your pension is not going to be passed on to your spouse or your civil partner. It kind of dies with you. However, if you're, remember I've just said that the government worked out what your starting amount was for the new state pension because they looked at the old rules. If you're entitled to more under the old rules, you're going to have a protected payment on top of the new state pension. That protected payment, 50% of that would pass to your spouse in the event of your death. So take a look at that. Now, under rules as they are now, if you've got a spouse or a civil partner and they die under state pension age, and they've paid national insurance, you are entitled to a bereavement support payment, and you can find details of that on the gov.uk website. Now, I think we're going to be about another 10 minutes, so if you can stay, please do. If not, watch the recording back, because this one's really important as well. Someone's put, I've heard that some women are not getting the amount of state pension that they should. Please can I explain that, because they're worried that their mum is affected. Okay, so under the rules of the old state pension that stopped in 2016, married women who reached state pension age before that date were entitled to a state pension that was worth 60% of what their husband's basic state pension was when he reached 65. Now, the reason that the government did that and made the women's pensions up to 60% of their husbands was that when the state pension was first set up, many women didn't qualify for a full basic state pension in their own right. And that was because up until 1977, women could actually opt to pay a reduced level of national insurance in return for a reduced state pension. But later down the line, the government decided to give an uplift or a top up to make sure that all women had at least 60% of the basic state pension that their husbands were receiving. Now, this is the important bit. If the husbands turned 65 before 2008, the women actually had to physically make the claim for that top up. It wasn't paid automatically. So there are lots of women out there who are not receiving the top up that they're entitled to. So if you've got a mum, an auntie, a family member that isn't getting at least £80 a week through the state pension, check it out. Call the pension service on 0800 731 0469 and they'll be able to tell you whether that person is entitled to a top up that they can now claim. Next question, can my spouse get any of my state pension if we were to divorce? Under new state pension rules, no, they can't. Under the old state pension rules, if there's any additional state pension or protected payment, yes, that can be divided under a pension sharing order. But really the new state pension rules, which for most of us we're going to get because we're retiring after 2016, it's really there to make it more simple. Someone's asked, does anybody lose under the new state pension rules? And yeah, there will be a few losers, just like any rule change, but it's mainly going to be those high earners that under the old rules would have had their basic state pension and then earned the right to an additional state pension because they were earning more and paying more national insurance. Under the new state pension, everything's equalised, everybody's hopefully going to get the same, which is around that £179 a week. And also, you know, you can no longer build up pension for your partners because it isn't passed on after your death. Next one, can I transfer a pension that I've built up with a previous employer to the state pension? And really simple answer to this, no, you cannot transfer any money that you've built up as a pot of money to the state pension, because the state pension isn't a pot of money, it's basically a future promise based on the national insurance that you paid. But if you do have previous pensions with old employers, you might be able to transfer them into your new workplace pensions, but this is something that you would need to get advice on. I think this is going to be the last question. Thank you so much for, I mean, I can just see the questions that keep coming. I'm going to go through them. I will answer you individually if you've asked a question that I haven't covered. As I say, I'll do a Q&A that I'll send out as well. But this is the last question for today. Is a UK state pension reduced if I also get an EU state pension? And can I merge different state pensions that I'm entitled to? Right, really good question, particularly with Brexit going on. So if you've worked in several EU countries, you might have accumulated state pension rights in each of those countries at different times. Now, under Brexit rules, if you've accrued any state pension rights in other EU countries before the 31st of December 2020, the UK withdrawal agreement has protected those rights. That means you will still be entitled to receive them in the country that you choose to retire in. So when you get to state pension age in the country you're living in, that country is responsible for processing your claim and bringing together all of the records from those EU countries to make sure that you receive what you're entitled to. But word of warning, different countries have got different ages for state pensions. So let's say you're in Holland and their state pension is before ours. You won't get any entitlement to any UK state pension until you reach the state pension age of UK. So I hope that hasn't been too complicated. As I say, thank you so much for joining. It's just brilliant to have had you all here for Talk Money Week. As I close down the webinar today, there is going to be a really short survey. I'd appreciate that if you fill that in, because it just helps us to understand what people want to hear about and whether they found the webinar useful. But I hope it's answered your questions. Enjoy the rest of your day. And if you can join, we're doing Fixing Your Festive Finances tomorrow morning at 10 AM. Go on to the Better With Money website. You can sign up for it there. Just another free webinar to encourage us all to talk about money. It's lovely to see you. Speak to you soon. Bye-bye.